Well, good evening and welcome to the latest live show on the 10th of May 2022. Martin North from Digital Finance Analytics. Great to have you on board tonight. Very important conversation with Leith coming up. A lot of discussion around the economy, RBA, rates. We were saying beforehand that everyone's asking about where the rates are going and what it means. So we'll try and unpack that, but also happy to take your other questions too as we go through. Just before we bring Leith in, let me just remind you that we don't provide specific financial legal advice on the channel. The moderation of the chat room continues. This is at the 10th of May 2022. And if you'd like to ask a question, use @Walk the World to make sure that I see that. And also, I've enabled Super Chat, so if you want to get your question on top, you can do that, or indeed make a contribution to what we do here. And with that out the way, let me push this button. Leith, hello.
G'day, Martin. Hello, everyone. How are you?
Yeah, very good. How are you going?
Yeah, pretty good. Not too bad. It's getting cold here in Melbourne, but yeah, it's been good so far. But it's starting to pull out the winter woolies, which I don't like very much.
Well, at least you had a summer.
We did, yeah. It was one for the ages, I got to say.
Now, for those who haven't come across you before, why don't you just give your brief introduction, because I think it's really important people understand where you're coming from, but also very importantly, you've got a very strong economic background, so you're not just making this stuff up, you've actually got something a little bit more under the hood than that.
Yeah, well, so I basically graduated with honours economics at Melbourne University, worked at the Australian Treasury for 3 years, then worked at the Victorian Treasury for a year, then went to Goldman Sachs for 5 years, had enough of the corporate life, and then started up a independent website called MacroBusiness.com.au with my partner in crime, David Llewellyn-Smith. Been doing that for 10 years this year. And also work at the MB Fund as the chief economist with Damien Klass and Shelley and all the others there, and Sam. So, yeah, very busy. Basically, I'm just an independent economist and tend to have different views to, the mainstream, I guess, a lot of the time, a bit like yourself.
Yeah, well, we run a bit of a parallel track, but we cross over from time to time. It's great to have you on the show. I've got Damien on in a couple of weeks. It'll be interesting to get his view. But look, I guess we got to start with interest rates, right? I mean, because that is the talk of the town. And, just put this up. This is the latest 30-day interbank cash rate futures implied yield curve, right? So 3.6 or 3.7%, right, is what they're saying over the next 18 months or so. And, basically 2.5% by the end of the year, right? What's wrong with this picture?
Oh, it's completely bonkers. So, look, I saw that chart last week, and I've been following that chart for months. And basically, it was, it went absurd when it hit 3% by September next year, and then it went to 3.25, and then 3.5, and now it's at 3.7. Look, it's completely bonkers. If mortgage rates went up by that much, if they went to 2.5% by the end of the year, basically everybody's mortgage repayments are going to go up by about a third. If they go up to 3.7%, by September next year, everyone's mortgage rates from today, versus the start of this month, will go up about 50%. Now, for the typical, on the median priced Australian home, that would equate to about $1,500 a month in extra mortgage repayments by September next year. And for homeowners in Sydney, or the purchaser of the owner of the median priced home in Sydney, assuming a 20% deposit and principal and interest loan over 30 years, they'd be looking at over $2,000 of extra mortgage repayments. Now, I don't know about you, but I don't think there's too many households in the country that could cop a $1,500 or even $1,000 or $500 a month increase in mortgage repayments without serious economic harm. There'd be forced sales galore, property prices would crash, and the economy would be very likely thrown into a recession for the simple fact that household consumption comprises nearly 60% of economic growth in the country. And obviously, if people are paying, $1,000 extra a month or $1,500 extra a month, or in the case of Sydney siders, $2,000 extra a month, they're not going to be able to spend it elsewhere in the economy. So you're going to have a massive crash in household consumption, and that's going to throw the economy into recession. So, look, personally, I think those forecasts are absolutely bonkers. They're delusional, and there's no way the Reserve Bank of Australia would follow through. And if they did, we'd have, the real recession we didn't have to have, and a deep recession and a massive house price crash. So, look, I'll be honest with you. There's only one mainstream economist who I think has got this right, and that's Gareth Aird at the CBA. He's the head of Australian economics. Gareth Aird's tipping a terminal peak in the cash rate of 1.25%. And I've been saying since the start of the year that I reckon about 1% is probably enough. And Gareth thinks that we're not going to go above 1.25% for that simple fact that Australian mortgage holders are so indebted that anything greater than that is going to smash household consumption. It's going to and cause a house price crash. So, I think Gareth Aird's about the only one who's talking sense here. And, Westpac, ANZ, they're all tipping over 2%. I think NAB's about similar. And then the markets are tipping 3.7%. So, and Phil Lowe came out earlier this week or last week when he did the decision and said that we shouldn't be shocked if interest rates go to 2.5%, which again is a 1/3 increase in mortgage repayments. I think, I think the economics fraternity, other than Gareth Aird's gone completely mad.
Yeah. Well, there's a couple of interesting observations. The first is how much of the inflation, inflation is very strong, 5.1 or 6.6 for the non-discretionary sector. But how much of that inflation is actually being driven by other than supply chain, right? And
not much.
Right. Well, that then suggests that lifting interest rates isn't necessarily going to have much impact on inflation.
No. Well, so Australia's inflation is primarily imported, right? So we've seen at the petrol pump, you go to the petrol station, even despite the government cutting the fuel excise by 22 cents in the budget. Today I saw, Melbourne, it's getting close to $2 again. So we've all seen it. The petrol prices have gone through the roof. There's obviously supply chain issues elsewhere because of the trade issues out of China, etc. So you're seeing, imported cost inflation on raw materials and that sort of stuff. But the thing about it is that stuff tends to happen, it's a one-off price increase. Think about it like when the GST was introduced in 2000. Prices went up almost 10% straight away, right? So that was like a shock, but we all knew that was there. We're kind of going through a similar thing again. So, petrol prices have gone up to about $2 now. Next quarter, they'd have to go up to $2.20 and then $2.40, and they have to keep going up for inflation to keep rising.
Yep.
Even if petrol prices stay at the current level and input costs stay at the current level, albeit a lot higher than they were, that means that inflation going forward won't rise. So there's a bit of an issue here in that I see parallels, not in the way it's come about, but parallels to the global financial crisis, where we had the RBA raise rates heavily into the global financial crisis. And then, 6 to 8 months later, I think it was, they had to then suddenly reverse track and then they cut interest rates sharply. I wouldn't be surprised if in a year's time, we have central banks around the world cutting interest rates because all these supply chain issues will hopefully have washed through, and we'll have economies around the world slowing quite heavily on the back of monetary tightening, and they'll be forced to reverse track. And that's kind of what happened to the GFC here in Australia. I wouldn't be surprised if we have that kind of, thing happen again where the RBA, hopefully doesn't, but it might go too far and then has to reverse track and then start slashing rates again because the economy is slowing so quickly and house prices are tanking.
Right, and it's interesting if you take the Federal Reserve as an example, right? They have changed their tune over the last few months too, because they were saying for a long time it's temporary, it's it's going to correct itself, and then suddenly Powell's now coming out saying, "Oh, we got to lift rates quickly." Now you got to argue there's a political motivation there, isn't there?
Oh, absolutely, and in Australia as well. I think there's been a bit of a push to. I was actually very surprised the RBA raised rates last week, although they did do it in 2007 as well, right in the heart of an election campaign, especially when there's no reason why the RBA couldn't have waited another month and wait to see what the actual wage price data is, which comes out, I think, next week. Because for the last year, the RBA has told us repeatedly that they're going to be patient and they're going to wait till they see actual wage growth before they raise rates, because that'll tell the RBA that the inflation is sustainable. Instead, only 6 weeks ago, they reiterated that. And then in the latest statement, they've gone and reversed track. And now they're saying that, businesses are telling us the wages are going up. So they're going from saying we've got to observe it because we got wage growth wrong for a decade on businesses' advice, to actually seeing it, to suddenly going back to that, no, we're just, we're being told wages are going up, so we're going to raise interest rates. And it'll be interesting to see if in a week's time, maybe it's 10 days later, sort of mid to late this month, what the wage price index comes out. What happens if it comes in weak? So wage growth is currently about 2.3%. What if it doesn't really pick up? What's the RBA going to do then? And then I think there would be a bit of a, you could say it was almost political because they did it during the election campaign when they really should have waited to get that confirmation. I mean, they could have waited one more month just to see if the wage growth is there. But anyway, I think I totally skirted over your answer, but I didn't mean to.
No, that's
went off on a tangent.
No, that's fine. But it's an important tangent, right? There's two observations there. The first is that the liaison, right, according to reports I read, it was very narrow, right? It wasn't statistically particularly robust, right? It just happened to be pointing in the direction that they wanted to see it, so they sort of reported it, right? That's my first observation. The second observation, though, is this. This is actually from the Centre for Future Work, and they've basically plumbed in now the RBA's estimates of real wages growth, taking account of all the latest estimates. And what they're basically saying is that they suggest that by June 2024, real wages will be the same as they were in March 2012. So, even the RBA is in his central forecast is not necessarily suggesting that in real terms wages are going to go up.
That's right. Well, even in nominal terms, so their statement of monetary policy last week said that it'll take till December this year before wage growth, like nominal wage growth, so this is including inflation, hits 3%. So it's like they've been telling us for a year that they're not going to raise interest rates till wage growth goes above 3%. And yet they're already raising interest rates when their own forecasts say that wage growth is not going to hit 3% until the end of the year. So there's this whole weird, basically what I think happened is the Reserve Bank's come under so much pressure from financial markets, from economists, et cetera, who've just been banging the drum on interest rate rises, that now they've got their own confirmation bias and that they've said, okay, we need a smoking gun. Oh, we'll use liaison. Liaison's a smoking gun. But what they don't recognise is since 2013, they've had wage growth doing this in every single forecast, and it's gone like that instead. So they've been predicting wage rises for about almost 10 years, yet they were wrong consistently. And those wage growth forecasts would have been based on the very liaison that they're now basing their wage pressure claims on. So it's kind of, it's a bit ridiculous here. They should have waited another month. It wouldn't have done any harm to actually get the wage price index data from the ABS because it's due out in about a week or a week and a half. And then that way they could have actually, been consistent with what they've been saying for a year. Yeah. It does. I mean, I'm not saying it's not necessarily political. I don't think maybe they haven't done it because it's an election campaign, but they've certainly been hasty with it, and they've kind of folded like a cheap suit to the pressure of economists and financial markets.
Sorry, just to interrupt. Do you think that's partly because the New Zealand, Bank of England and Fed already move rates, right? Do you think that international pressure was also there too?
Yeah, probably. And then that feeds in the whole narrative from the financial markets here and the economists, et cetera, et cetera. Look, I'll be honest, I don't think a cash rate of 0.1% was appropriate given the market we've got now, right? I think rates should be higher than they are. But it's just the way the RBA is going about it. And it's also for Phil Lowe to then say, don't be surprised if rates go to 2.5%, which is absolutely absurd. Like, are we really going to raise people's mortgage rates by double? From those who borrowed last year, we're going to raise them by double? That's ridiculous. But that being said, I'll give him one benefit of the doubt. He probably said that to jawbone the market. So he's trying to scare people not to be reckless. So he said, don't be surprised they go to 2.5%, but he might not actually be at all planning to go through with that. No. He's just said it as a form of jawboning to try and, if he says it, if he warns people, if he scares them, he won't have to follow through as hard. Maybe that's his logic. But it's still bonkers. Like a 2.5% increase in the cash rate when you had people borrowing at 2.5% or less last year on mortgages. Well, it's going to double their mortgage rates. And it's going to increase their principal and interest mortgage repayments by about a third. So, we had a quarter of loans in the December quarter in Australia were a debt to income ratio above 6 times. Throughout last year, the debt to income ratio on mortgages, there was about 20% of mortgages were at these very high debt to income ratios. Well, if mortgage rates double, those people are stuffed. There's no doubt about it. I just don't think they can I don't think a household's going to sail through such a steep rise in mortgage rates without serious harm, both to the housing market, to household finances, and the economy.
Yeah, absolutely. And just a couple of stake in the ground. This is my latest mortgage trust data. This is actually the end of April. 42% of households have cash flow pressures already. So yeah, I measure stress in terms of cash flow cash flow terms, not a specific proportion going to pay the mortgage, right? So that means there are a lot of people already in some difficulty. And if you were to actually put the rates up, then this is what happens with the extra households that effectively get sucked in as rates go up. So if they go up another 2%, you've got a significant number of additional households who get pulled in. And I think the other point, just to re-emphasise, because you made it quite quickly, because quite a lot of the economic momentum in the economy is consumer spending, if consumers are spending more on higher interest rates, they're going to spend less in other things. So it actually crushes growth.
Oh, absolutely. I mean, I think the actual figure is 55% of final demand. So that's basically GDP leaving out net exports. So it's the money that's spent in the economy. 55% of it historically has been in household consumption. So basically where consumption goes, the economy goes generally. It follows that trend. And obviously during the start of the pandemic, we had economic growth contracted quite sharply because of lockdowns, consumption tanked. And then it rebounded quite strongly because consumption, once lockdown has ended and stimulus, etc., consumption boomed. But if we're going to have mortgage repayments go up by a third or a half, or even 20%, that's going to have a massive impact on obviously household consumption. And even under Gareth Aird's low end forecast of a 1.25% cash rate, you're still going to have mortgage repayments rise by about 14%, which would then take us back to what they were at the start of the pandemic, the repayments to disposable income. So I think that's a more sensible approach. Sort of bring us back to the pre-pandemic level is probably the max we can handle without, sending the economy into a tailspin. But anything above that, which is basically every economist forecast other than CBA and the markets are predicting, is completely bonkers and way off mark.
Yeah, and this was from Westpac. So it basically said that if interest rates have a terminal of 4%, then that puts us right back to where we were way back then, right? And even at 2 or 3%, it's going to be a real pain. And of course,
I think that chart's based on the RBA's interest repayment data. There's a better one. There's a better one for the Bank for International Settlements, which does principal and interest.
Okay.
I've done some work on that. So has Gareth Aird. He's used the same, and his shows that a 1.25% cash rate, the principal and interest repayments will be the same as what they were pre-pandemic, whereas that one, the interest is a bit over.
Yeah.
But the bigger note is anything above 2%, so a 2% cash rate rise or mortgage rate rise will bring mortgage debt repayments back to the level they were at the very peak of our history in 2008.
Yep.
So it only takes a 2% rise in interest rates to bring us back to our highest ever level of mortgage repayments.
Yep.
Debt repayments to household disposable income. Anything above that will be territory we'd never seen before. And just bear in mind that through the 2008 peak, it only stayed there for momentarily because the RBA quickly cut rates because they knew households couldn't take it, and it was sending the economy into a tailspin. So that sort of gives you a sense that anything much above 1.25% is going to be pretty hard to take, and especially given obviously the level of household debt now is way higher than it was back then, and households are so sensitive to rate rises.
Yep. Well, we know they're very sensitive. And I guess the other question, the banks keep saying, well, everyone's got lots of buffers, right? They've got all of this money saved, et cetera, et cetera, et cetera. And then they're saying the bad debt levels are very, very low, so there's nothing to see here, move on. The question is, are they actually giving us the full picture?
Yeah, well, I mean, all that's always a lag. So obviously we've had 2 years of 18 months of extremely strong asset price growth. So, of course, bad debts always look good when you're basically at that turning point. So, obviously rates have only just risen, and asset prices, housing in particular, has skyrocketed. So of course it's going to look good, but that can change pretty quickly if the situation changes and they suddenly ramp up mortgage rates and then house prices fall, which is, Sydney and Melbourne are already starting to fall now, just, obviously modestly. But it's just the beginning. And, if we start getting mortgage rates ramp up aggressively, well, then those house prices are going to fall very sharply. And that's going to, I think, turn those sort of, default rates or arrears can quickly turn the other way.
Yeah.
So, you're sort of taking the best figures we've got. The snapshot in time before, obviously, the proverbials hit the fan.
Yeah. So it's the lowest absolute rates at the moment. And, of course, we've got the nearly $1 trillion of debt, public debt, piling up in the background too.
Yeah. Which I'm not so concerned about public debt. I mean, that's let's face it, the government controls the currency. They can do the funny money, whatever, to pay that. It's the private debt that always worries me. And obviously that's predominantly mortgages. So yeah, I think I honestly think that we're going to have. I'm going to write a report on this for the mid-year report for MacroBusiness, but I wouldn't be surprised if we've, forget the GFC, we're going to have the GHC, the global housing crash, next year, purely because we've had this synchronised house price boom over the pandemic, and it's all been driven by, obviously, central banks doing quantitative easing, dropping mortgage rates through the floor, drove really a synchronised housing boom everywhere. New Zealand went up 45%, I think, in the last 2 years, the RBNZ said. We boomed not by as much, but, massively. Canada, everywhere went through the roof. And now we've got this synchronised rise in interest rates, obviously, as the central banks go the other way and they pull back. So, obviously, cheap and available credit caused the boom. And if you reverse those circumstances, well, you're going to get the reverse. Now, it doesn't necessarily mean prices are going to fall 30%, 40%, whatever. But we could find a pretty heavy housing corrections almost across the board next year. I wouldn't be surprised. It's something I need to look at a bit more. But it's what's going to happen in Australia, or what's happening in New Zealand right now, is pretty much happening elsewhere.
Yep.
And synchronised house price boom on cheap credit, you tighten that credit, you're going to get a synchronised house price correction.
Yeah.
Seems pretty logical.
Two observations. New Zealand's a bit ahead of the curve, right? So they started lifting rates last October and they're at 1.5%. They're already forecasting at least a 20% fall in house prices. Credit has come off and the markets have slowed. So you can sort of see where it goes. And, I have a feeling that most of the central banks got the same memo, basically.
Yeah, actually, so I follow New Zealand very closely. So, quite a few of our readers at MacroBusiness are Kiwis, and so I try and, for years I've tried to follow it, give them, a decent amount of coverage, and I've been following the New Zealand housing market for years. And what's happening over there right now is quite scary. So, if you reckon Australia had loose lending last year, so I mentioned that in the December quarter, 25% of mortgages, according to APRA data, were debt-to-income ratios over 6. In New Zealand, over the whole calendar year, a full one third of mortgages in 2021 were at debt-to-income ratios above 6.
Yep.
Like they make us look responsible. And obviously the house price rises over the pandemic. I think they were close to 42 or 45%. I think it was, according to the RBNZ, in the 2 years leading up to now. Dwarfs what we had. Like, it was and New Zealand's housing stock to GDP, ours is about 4 times, theirs is about 4.5 times. So their housing market is way more overvalued than us. So if you think Australia's bad, New Zealand's worse. So New Zealand would be like equating Sydney house prices to Melbourne house prices. If Australia was Melbourne, New Zealand, Sydney. Like, New Zealand, Sydney makes Melbourne house prices look sensible, even though they're not. And so New Zealand's, as you said, they're ahead of the curve. The RBNZ's already been raising rates I think they're about 1% now.
1.5.
The cash rate.
1.5.
Yeah, sorry, geez, yeah. I'm on the curve. I forgot they did it last week. So, yeah, sorry, 1.5%. They brought in some responsible lending rules in December, which has also tightened credit. Jacinda Ardern has been hyper aggressive on mortgage on investor lending. So they basically banned negative gearing 2 years ago, and then last year she went one step further and she's banned deductibility for investors. So that basically means if you're a property investor, you can't even claim your interest tax expense against your home. So that's smashed the investors as well. So they've had this kind of extreme pro-cyclical housing market where it was ultra loose last year, and then now it's been tightened quite aggressively. And as a result, prices have already fallen about 4.5% since November, but the pace of falls is steepening. And basically, there was this REI, Real Estate Institute New Zealand survey that came out about a week ago, run by this guy called Tony Alexander, who's like New Zealand's housing guru. And it was the most bearish stuff I've ever read. Like every single indicator was basically the worst it's been on record, whether it's number of buyers, investor demand, first home buyer demand. They have all these different indicators, time to sell, all this sort of stuff. Everything was at its worst ever level. And I read that, I was like, whoa, this place is really, New Zealand really is leading the tip of the spear here. And it's almost, you got to remember, New Zealand's big four banks are Australia's big four banks. So it's kind of a canary in the coal mine, I think, about what could happen here. And it's actually worse placed than Australia when it comes to, a housing correction. So I'm watching New Zealand very closely. If you want to read New Zealand stuff, go to MacroBusiness. I pretty much put an article up about it every day. And I'm following it really closely because it sort of gives you some nice hints about what could be in store for us, especially across Sydney and Melbourne.
Yeah, I think we saw Adrian Orr was in front of one of the parliamentary committees last week and was given a really hard time. And he basically said, well, we can only deal with what we were dealing with at the time, because they accused him basically of taking interest rates too low and overstimulating the economy, which is, convenient in hindsight. But he basically still said, well, we're just normalising monetary policy now. That's what we're doing.
Yeah, that's right. And their financial stability report, it's just like the RBA's one. It's released every twice a year, and that came out last week, and it's really good reading actually. Like, it's pretty honest. And they basically just said that there's a truckload of recent home buyers that are going to have great difficulty because they bought at super low rates. New Zealand buyers tend to buy more in fixed rates there. 1 year fixed rate or 2 year fixed rate. And they've got a massive amount of, home buyers who are going to refinance this year at basically double the mortgage rate. And, again, a lot of these people bought with debt to income ratios above 6 times, and they're going to be stuck with this double whammy of suddenly having a huge ramp up in mortgage repayments and becoming under, severe financial stress there at the same time as their asset probably goes into negative equity as well, because house prices are falling. So it's a pretty dicey situation, and it's it's been caused by this ultra loose monetary policy, and then now the reverse of that.
Absolutely. Well, let's move the conversation slightly forward. In New Zealand, there was negative migration over the last year, 18 months, as in Australia. So you can't blame migration for the price rises. But in a market that's now potentially adjusting, one of the, quote, easy, unquote, levers is clearly going to be increasing migration. And yet, of course, neither side in the political debate currently before the election is going to mention it. But there is a big push for it, isn't there? Oh,
absolutely. I think it's a fait accompli. The big three levers of government, which is the business lobby, the property lobby, and education migration lobby, i.e. universities or the higher education sector, all want, they all love big Australia immigration because it lines their pockets, and unfortunately they pull our policymakers' strings. So, it's, I guess, one of the tragedies, I guess, of the housing market. We always talk about house prices and how hard it is to buy a home and how expensive it is and how much debt you got to service, which is all true. But the bigger issue is actually what's going on in the rental market. We've got, at the moment, it's quite perverse, despite the fact that immigration went negative. We've actually got the tightest rental vacancies almost on record, and rents are booming. They're up about 10% year on year. So we've got this rental crisis. And the reason why that seems to have happened is because the pandemic has kind of created this drive for more space. So people want space. Obviously, people have got second homes now. People who can afford it. They've bought the holiday houses and blah, blah, blah. And what that's meant is effectively you've had a shrinkage in the rental stock because the number of people per dwelling has fallen, which means that you effectively need more rental stock to service the same size population. And so despite the fact that immigration went negative, we've had this, this shrinkage in household size, which has basically smashed the rental market and driven rental rates up. And now policymakers want to double down on that and make it even worse by rebooting this big Australian immigration. So I think the rental market is in for an absolute torrid time. I can see rental vacancies becoming even more problematic and rents surging even more purely because on top of this pandemic-induced shrinkage in household size, we're now going to import 200,000 plus people every year into the country to make the whole problem worse. But so I think renters are, in a lot of respects, are the real victims of this whole housing, pandemic housing boom. And both sides are going to make it worse, unfortunately. Cheered on by think tanks like the Great Institute, who love it, despite whinging about housing supply constantly, whinging about lack of social housing, whinging about too many emissions, yet they support big Australian immigration.
Yeah, absolutely. And the whole point about the migration issue is that it's about numbers, but it's also about the types of people who are coming in. Because the other thing, of course, that the business lobby is pushing for is cheap labour coming in, right? Actually, they don't want to pay local wages to local people, which cost them more. So if you actually look below the surface, their argument is it's about keeping labour costs down, which takes me to the other side of the equation, which is, and I asked Steve Keen this last week on the show, are low wages a feature or a bug in the system, right? And it seems to me that low wages is actually, it's not a bug, it's actually a design.
Oh, absolutely, it's a design. Alan Kohler wrote a terrific article about a month ago, put on MacroBusiness, where he basically said that Australia's immigration program is effectively work choices 2.0. And it was deliberately designed to smash unions and erode workers' bargaining power and keep wage costs low. And I think he's right. There's no doubt about it. And isn't it hilarious how the business lobby continually whinges about housing shortages, about labour shortages constantly, and we need to bring in more migrants, etc. Yet when the unions ask for, a minimum wage rise that's slightly above the inflation rate, they scream blue murder. We can't have that. Well, if there's such if there's such labour shortages everywhere, shouldn't you be paying more to alleviate those shortages? Isn't that how a market is supposed to work? Yet the business lobby doesn't believe. They only believe in the market when it suits them. They don't believe in the market when it means that they've got to actually pay their labour properly or to create a wage that clears the market. And it really is a feature of the system. And unfortunately, politicians, the business lobby, etc., are now using the threat of rising interest rates to argue against wage rises. They're saying, we can't lift wages because then your interest rate will go up because the RBA will be forced to raise interest rates more. And that's the latest thing. And it brings you back to this whole problem where housing inflation is good, but wage inflation is bad. That's their view. You never see them complaining when house prices are going through the roof and the cost of house prices and rents are going through the roof. The cost of shelter is going up. But geez, do they complain when we get a little bit of upward wage pressure? It's unbelievable.
Yeah, absolutely. And of course, the true story is that for many people, wages have not grown at all since 2012-13. And if you compare that with the early 2000s, when prices were also quite strong and rates were going up, their wages growth was quite strong. But it's not following the same way now. Costs are going up, wages aren't, interest rates are going up, which is why, of course, that pincer movement then hits households so badly. But nobody really wants to tackle the fundamental structural issue that we're talking about here. And I think the other point we should make is that the mix of jobs is really important to understand, right? There is definitely some wage rises in some industries like IT, for example.
Yeah.
And in a couple of other specialist areas. But if you look at, for example, social care or aged care, there it's grinding along the bottom and no way out. And it's interesting that Andrew Bailey from the Bank of England in the UK actually said in a statement about a month ago, don't go seeking significant wages growth because it will help to power inflation.
Yeah, I know. It's like they don't seem to. It's fine to have shelter inflation, right? So the cost of our shelter goes up.
Yep.
They don't seem to mind when toll roads, when Transurban raises the toll road price by 4% every year because that's locked in by the contracts. That sort of inflation is fine, but hey, geez, you can't pay your workers more. It's a real bugbear of mine, and I think one thing the pandemic induced, like getting back to the immigration thing. One thing this collapse in immigration has shown is that one of the main reasons why we had, I guess, low wage growth the last decade and obviously higher unemployment than we should have had is because we ran immigration so hard. Now that immigration's gone, we've now got the lowest unemployment rate. It's about to be the lowest unemployment rate since the mid-1970s and the lowest underemployment rate since 2008. And that's purely because 500,000 foreign workers left. And basically, despite the fact that Australia has created less jobs, the trend growth in jobs has been less than it was pre-pandemic. We've now got this, 40-year low unemployment rate purely because employers have been forced to hire unemployed Australians rather than a migrant worker. And that should be like that. It's as close as you can get to a controlled experiment we've had the last 2 years. Yep. And the proof's in the pudding. And obviously that's now starting to drive some upward pressure in wages, which is good. But now the employers are, well, on the one hand, they're complaining about skill shortages, but then they're saying they don't want to raise wages, which is how you get rid of those labour shortages. It's the whole system's a bit of a joke. It's contradictory, and unfortunately, Steve Keen's right. It is a feature of the system. It's not a bug. Yeah. It's been designed this way. Yeah. Smashing unions. Obviously, immigration is just one side of it. It's a big side of it, and there's all these other factors that have basically caused this sort of low wage economy we've gotten, and it has been replicated to a large extent across other countries, but we happen to run the immigration harder than most other countries. So that's just another headwind for wages that we've created for ourselves.
Yeah, and Matthias Cormann, of course, actually pretty much admitted as much a few years ago, didn't he, before he went off to the OECD. Yeah,
that's right. He actually said it on ABC Live. He said it's the system's designed to keep wage costs low. Mm. It's one of those. You always get this little. I think it was a slip up by him because he was actually a politician at the time. Usually, you get the honesty in their last speech before they leave. Like Joe Hockey got up and said, "Oh, we should get rid of negative gearing," after defending it for years in his last speech. It's usually the only time you actually get a bit of honesty is when they're out the door. But yeah, Matthias Cormann actually said it while he was a sitting member, but just before he left. He admitted that basically the system designed around keeping wage costs low for business.
Exactly. And just the other point on that employment number, 500,000 temporary workers and foreign migrants left the country at the start of the COVID outbreak. That's why we have an unemployment rate with a 3 or late 3, early 4 in front of it, depending on how you measure it. But
absolutely.
It's completely artificial.
It is, and it's artificial, but it's not. I guess it's artificial because you wouldn't usually lose migrants. Mm. But the flip side of that is it's artificial to run immigration at an average of about 230,000 a year, like we did for the last 15 years. Yep. So I'd argue that that's artificial as well. I mean, the normal amount of immigration was about 100,000 a year, and that's what it was pre 2005, and that's what it was for decades. It was around about bounced around a bit, but it was about 100,000 a year. It's actually a bit less than that, and so yes, it's abnormal to obviously lose 500,000 people, but it's also should be viewed as abnormal to import 230,000 a year for 15 years when the historical average is more like 100. So both are pretty much abnormal. But what it does show you is that if you want to have full employment and you want to give workers more bargaining power, you don't go about that by by basically growing your labour supply by 25,000 a month, which is what occurred, the 5 years pre-pandemic. Since the pandemic's hit, it's been averaging about, it's about 7,000 a month, I think. So it's barely, the labour force has been growing very slowly, just through natural increase in that, but it's grown, it's grown at a much, much slower rate. And then that's meant that the growing jobs, albeit despite the fact that jobs growth has been less, it's lagged the pre-pandemic trend, more of those jobs have gone to unemployed Australians because they're not constantly importing migrants to take those jobs. Now, the Grattan Institute will say, oh, that's xenophobic. It's all about stimulus. It's not. If you don't believe me, go and read Bill Mitchell's work on it, Professor Bill Mitchell. He runs I can't remember the name, he's got a long name, but he's basically an employment expert, economics professor. He's done extensive research on it. And he's estimated, and he's done a whole model on it, that Australia's unemployment rate would be about 6.5% if we had the same circumstances we do now, but we'd run pre-COVID immigration levels. So, it's a pretty big increase, 2.5% higher than it is now, simply if we'd run immigration at the same level as we had, if we kept immigration going to pre-COVID levels. And so, the thing that's disappointing about this is we've had this election campaign, and I was hoping that Labor would, when the government comes out and boasts about jobs and the lowest unemployment rate in 40 years, blah, 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 I was hoping Labor would say, no, but that's because you shut the border. But it's like, obviously Labor wants to reboot the immigration system. So they've both sides got this gentleman's agreement not to mention immigration.
Yes.
Even though that's the main driver of why we've got such low unemployment now, the collapse in immigration. Yep. And I was hoping Labor would at least mention it, so then I could point it out and go, see, I was right all along. but they refused to mention it, unfortunately. And and anyone who does do it, like Sally McManus mentioned it, she got shouted down, called a racist, blah, blah, blah. Anyone who does mention the obvious basically gets shouted down because you're not allowed to mention it because it's xenophobic, supposedly.
That's right. Well, the two sides, of course, want to be the same, right? So, it's a mirror image of each other. You don't want to have any light between them for fear of being, split apart and creating all the stuff we had 3 years ago. Now, here's one from Stripy Cat, which follows on quite nicely. What are the chances of wage rises in the face of increased costs to businesses due to inflation and future rises to compulsory super payments from 9.5 to 12.5 in coming years?
Yeah, I think wage growth will pick up just because of the tight labour market, but certainly that's a good point about superannuation. So basically every year the superannuation guarantees is scheduled to rise by 0.5%. And we know from historical experience and that any increase in almost all of the increase in compulsory superannuation comes from your take-home pay. So effectively that's going to be a drain on wage growth. So I think wage growth will pick up anyway, but it'll be in spite of the negative drag of 0.5% a year from compulsory superannuation. But that'll certainly be a drag I hadn't thought about, actually. I wrote about that last year and I forgot all about it. So I'm glad that
it's a really good point. And
it is. So basically, the compulsory superannuation guarantee was 9.5% last year. It went up to I think 10, and then last year. But over the 4 years, whatever it is, it's supposed to go up 0.5% every year. That's ended up being about a 2.5% drain on wage growth, or thereabouts, maybe 2% over that period. So effectively, workers are already got a headwind there just by the fact that the compulsory superannuation guarantee is increasing, and that should temper wage growth. And then if you believe all the panic merchants, that'll also temper inflation. Yep. Which they'd probably argue is a good thing. I'll be quite direct. I hate compulsory superannuation. I think it's the dumbest policy ever. If I had my way, I'd get rid of the superannuation system, the compulsory superannuation system. I'd bank the savings, which are massive, and use it to do a universal pension. I think that'd be a much smarter, more equitable and cost-effective way to do it. But that's probably an argument for another day.
I think let's just touch on it briefly because there's two factors there. The first is that the costs embedded in the superannuation system with all of the various fees and charges and everything else that is taken out and all the middlemen and everything else,
30 billion.
Yeah, it's huge, right? When the second, of course, everyone is now market exposed, right?
Yep.
So if you think about what's happening to the prices, in the markets at the moment, they're down 15, 20%. A lot of superannuation pools, therefore, are going down as well. So actually, this superannuation thing is actually now creating significant pressure because of the way that it's being constructed, both on the way in, on the way through, and also potentially on the way out. It is not actually fit for purpose, in my view.
No, it's not. And the thing about it is, it's obviously we've got the situation where the bulk of the benefits go to higher income earners. So you end up with wealthy people accumulating these massive nest eggs, which, let's face it, they don't need. And that costs the taxpayers a hell of a lot of money because of all the concessions. It's a stupid system in that it's based on how long you work and how much you earn. So that automatically screws over low income earners, or people have to work part-time. So it's not based on need. Yep. It's based on that. And then the bigger issue is it costs the federal budget more than it saves in lower pension costs. And that's been proven by the Treasury and everyone else. It'd be so much more cost effective and equitable to get rid of it, bank tens of billions of dollars in savings in, superannuation concessions and the like, and just simply raise the age pension or make it. I honestly think New Zealand's got a much better system. So New Zealand has basically a non-means tested universal age pension. So when you hit, I think it's 65, everyone gets like a universal basic income, right? And basically you might go, oh, that's unfair because rich people get it, but everyone gets it. And what it does is it doesn't discourage. So it basically means if you're an old person, you get the age pension, you can keep working and you'll still get it. You don't lose it. But what it means is you end up just paying a higher rate of income tax on your labour income. And the reason why that's good is that the percentage of pensioners that work in the labour market in Australia is like 3%. New Zealand's about 15%. And the reason why it's 3% is no older age person wants to work because then they'll lose the pension. So it's this massive disability. So we've got politicians, businesses, everyone whinging about labour shortages, and yet we've got a system that explicitly penalises older people for working, versus New Zealand system where we've got a universal pension, and then people effectively aren't penalised for working because they still keep the pension. They end up just paying a much higher income tax on the money they earn, which is a much smarter way to do it. And actually, a lot of other countries around actually have the New Zealand approach as well, and it works. And their labour force participation amongst older people is more like 20 to 25%, versus ours where, pensioners is like 3%. So, yeah, look, there'd be much better ways to do it. You cut out $30 billion of, fee-sucking parasites. And this is coming from someone who's, through Nucleus Wealth actually runs a super fund, but I can still admit it's flawed. But, if you look at it from a top level, it's a dastardly policy that we've created. But unfortunately, it's so powerful now, it's so big. The superannuation industry is its own machine. They pump out heaps of spurious resources. They've got billions of dollars at their disposal. And unfortunately, it's, the Frankenstein has taken over, the Frankenstein monster of superannuation has taken over its master. So we're stuck with it.
Yeah, absolutely. Well, if you put that alongside the mortgage industry as well, you realise just how messed up the whole of the economy is, thanks to these experiments in finance that was sort of set off a few decades back.
Yeah, unfortunately, the fire industry basically burnt the economy.
Yeah, exactly right. Well, my analogy I've used before, I think, is the event horizon, right? Where more and more and more of the economy effectively gets tipped over the event horizon, which is the financial system, right? And, the old quote about, well, you've got, a housing market or a financial system, and then you've got a real economy bolted on around the edge if you're lucky.
Yeah, well, I mean, I've used that to explain New Zealand before. I think actually Bernard Hickey is a commentator there once. He said, and it applies to Australia, but I've said multiple times that New Zealand's a housing bubble with an economy attached.
Yep.
And we are the same to a lesser extent because we've also got mining. But it's similar forces at play.
Houses and holes, right?
Yeah, that's right.
Okay, this is one from Jason. Jason, thanks for the super chat too. Really appreciate it. Martin and Leith, do you believe that corporates will reevaluate the cost of just-in-time delivery systems as they risk manage the disruption it creates for their lines in the current times, given GIT has failed, and bring it back on shore?
Yeah, I think the whole world's going to have a period of deglobalization to a degree. Where, I mean, most of the manufacturing probably still be made out of China for the time being, whatever. But I think we're going to move into a system of, I guess, trade blocks where you might have, say, Russia, China as like the axis powers, I guess, and then the rest of the world will be something else under a different trade system. But I also think a lot of economies, Australia probably not so much because I don't know, we don't own a manufacturer or anything, but you see it in the US where a lot of manufacturing is moving back onshore because of that whole supply chain problem. The whole just-in-time mentality, which works great when everything's working well, but as soon as you get a hiccup, somewhere along the line, it stuffs up. We've seen that with computers, car manufacturing, everything. So I wouldn't be surprised if we get a period of deglobalization where more manufacturing gets pulled back onshore across a lot of countries. I'm not sure about Australia. I mean, we might just shift our supply lines a bit from, away from our Cold War enemies effectively to other nations.
Yeah, we seem to be just moving the problem rather than solving the problem. And I'm still amazed how I keep getting the stories of, the raw materials that we dig up here shipped over somewhere to turn into something else, and then we bring them back in at a much higher cost. Yeah,
I'm more worried about them coming back in bombs, eventually. So, to be quite honest with you, with all this Solomon stuff. But yeah, to your point, you're 100% right. We don't believe in value add here, unfortunately. It's a shame, isn't it? Like the sort of economic. My partner in crime, Dave Llewellyn-Smith, all those years ago when he, back in, I think 2010 when I first met him, and he had his houses and holes blog. It was just the perfect analogy for the Australian economy, and it hasn't changed in the 12 years since. That's basically it, houses and holes.
Well, the economic base has actually reduced further, hasn't it?
Yeah, it has. Yeah, it's gotten worse. So Australia has, I think, the lowest manufacturing share in the OECD, which is pretty pathetic, really. It must be when I was younger, I used to look at the UK and think, the UK's, they've been so financialised, they don't have a manufacturing industry. Well, they actually do. They do produce cars and other stuff. And compared to Australia, they're a bloody manufacturing powerhouse. We just, I wouldn't be surprised. I need to look into it, but the manufacturing we do have is probably just housing inputs, really. So, it's tied to housing probably anyway. It's probably just bricks and other stuff. So that's just an assumption, but it's probably right.
So one of the questions I wanted to explore a little bit with you was the lack of diversity in economic thought that is generally in the mainstream in Australia. Now, you've created MacroBusiness. I do my stuff, but actually, most of it's in the mainstream is just it's all the same. I guess I'd love you to sort of unpack why you think that's the case.
Follow the money.
Right.
It's just, unfortunately, most economists are bought in one way or another. And, I don't necessarily blame them. If we're going to earn a living, right? And I guess it's a rare breed to be like you and me to sort of go out on your own and try and, start a website and live off baked beans for years, which is basically what happened.
I know that.
You've got to be pretty brave, you know what I mean? And most economists work for, whether it's an industry group or whatever, and they're all got vested interests. Or like I look at the AFR economists. On some topics, they can be really sensible. Other ones, immigration, etc., they're just shills. The housing lobby, whether it's HIA, the property council, they've all got these in-house economists. They're all paid. They're all just there to spruik the company line and make it look legit. Same with the banks. There are some very good ones like Gareth Aird, etc. But it's the same kind of thing. And then And then you look at the so-called independent think tanks. If you look at who funds them, like the Grattan Institute, it's a big business lobby. I know they hate my guts, but I'm just calling it as it is. Look at their donor list. It's big business. And it's the same with, the Committee of Economic Development Australia. They're all the same, Business Council, blah, blah, blah. Unfortunately, then that creates this groupthink. And it's really just a money thing. The thing that gets me the most is that economists at the government who work for government who shouldn't have this vested interest do as well. And I noticed that when I was at the Australian Treasury, a lot of really smart people there. But we were indoctrinated from day one in Ken Henry's, he was the secretary at the time. Day one, we got indoctrinated with this 3 Ps crap. And basically, we were told Australia, the secret to raising Australia's wellbeing is the 3 Ps of productivity, participation, and population growth. The first one, productivity, no-brainer. That's the most important. Participation, yep, that's fair enough. You want to get more people working who, aren't in the labour force. The last one, population growth, immigration, is the dumbest, shouldn't even be there. Yet that was the one they drilled the hardest, and it's the one that's dominated policy making ever since. And you still see it. Like Treasury to this day spruced this 3 Ps framework. And me as a young economist at the time who went to the federal government, that was indoctrinated into me. And I must admit, like when you're young and naive, you go into those places and you hear that stuff and you think, oh, okay. And you don't think too critically about it. And it took me a few years to actually realise that the population P was an absolute garbage. But by that stage, I imagine a lot of economists at, the Australian Treasury, et cetera, they get taught that from such an early stage that it's just indoctrinated into them. Most economists are brought up on neoliberal economics, which is crap. I was brought up on that at uni. That's basically the standard textbook stuff. You're taught in neoliberal economics, and that kind of forms your thinking. So, you've got to be basically a rogue to go against it. And there's very few of us, unfortunately, who can see it for what it is. Steve Keen's one, I'm one. Steve and I have got, probably different views and stuff, but we're still unorthodox, I guess. You're another one. But we're pretty rare because, I go against a lot of the stuff I learned at uni and go against what was indoctrinated in me at the Australian Treasury when it comes to immigration, et cetera. But you've got to go against the grain, and it's easier and it's also more lucrative not to go against the grain because that's where the money is. There's way more money in being a paid shill, unfortunately. And there's a lot less money in not being a paid shill because if you're a paid shill, industry backs you, and that's where the money is. So I think that's why the whole economics profession, well, not the whole of it, but there are a lot of good ones, but by and large is, corrupted, unfortunately.
And
sorry, long-winded answer.
No. I think it's really important. And let me just take the argument slightly further, because the other thing I've noticed that when Phil Lowe stands up in front of the media, right, they serve him very gentle, low balls for him to back, right? There's no real penetrative thinking, and there's no real hard questioning of his philosophy or approach. I mean, he gave a press conference after the last announcement last week. You might as well not bother to watch it because there was no real sense of wanting to probe or test. I noticed the same with the Federal Reserve as well, because they run press conferences. But again, the questions that they ask these mandarins are just so weak. I don't fully understand why, but I sort of half do, I think.
Yeah, well, that was interesting because last year I thought the RBA had actually turned a corner. So when the pandemic hit, and you had Phil Lowe actually talk about, he actually did talk about immigration's impact on wages. That's what he cited that as one of the main reasons why Australia's wage growth sucked.
Yep. Is
because we've had this, constant positive labour supply shock.
Yep.
And he got shouted down as, being a lunatic, and you had Ronald Mizzen at the AFR, and the other bloke, whatever his name is, the other economist guy, young dude. We're all attacking him, doing attack pieces. Everyone was attacking him for being, racist, xenophobic. How dare he say that? Our immigration system's the best in the world. Blah blah blah. And he was just telling the truth. But it also, the reason why it rubbed on the wrong way is because it went against what he'd been saying the previous 5 years, where he's been just a big Australia shill and booster like everyone else. And unfortunately, he copped so much flack from stating the obvious that he's since gone back to his old ways. And so we had this like one year period where the RBA was lucid, not just on that topic, but other topics. And now they've just gone back to, as Dave Llewellyn Smith calls them, the lunatic RBA. Like they actually got their sense for like a year, and then now they're just going back to being lunatics. So I don't know. It's like someone's got to them, whether it's behind the scenes, business lobby, backers. I don't know. Look, I don't want to sound like a conspiracy theorist or whatever. But for some reason, they've rolled like a cheap suit, and they're no longer talking sense.
Yeah. But you see, it seems to me that central banks around the world have the same benefit. I used it in one of my recent shows. I said it's like, that everybody waits for the truth from God, right? So the central bank leader, delivers it, and everybody says, thank you very much, and off they go without any real critique or a real sense of, hang on a moment, but what about this, right?
That is annoying. Like the RBA is always held as the universal source of truth, right? so no matter what they say, like, I can write an article and someone's, no, the RBA says this. I don't care. Like, just because and then last year when they flipped on immigration, and I used it back on them and said, the RBA says this. It's like, oh, no, they're wrong. I guess everyone bends everything to suit their agenda or whatever they're, call it confirmation bias, whatever. I probably do it as well. But the fact of the matter is, like, by and large, the RBA is held up as a universal source of truth on everything. And what they say is the gospel. And it really shouldn't be that way. I mean, they're fallible like everyone else. I mean, we just look at their wage growth forecast for the last 10 years, for goodness sake.
Or their inflation forecast.
Yeah, exactly. Yeah. Well, I mean, the two things go hand in hand. Absolute garbage. Yet they're held up as this universal source of truth, the gospel, when we can't, thou shall not contradict the RBA.
Yeah.
Like the RBA has the final say.
Yeah.
And it's just like, I think reasonable minds can differ on things. But you don't get this discourse in Australia. It's like, you get it on my side, you get it from you, some independent guys like us do it. But by and large, it's like, it's just one big circle jerk. So to me, sorry, I shouldn't say that, but I'm just being honest. It's getting late. I'm getting, it's getting to the adults only hour. So, but that's kind of what it's become. And it used to annoy me, but now I laugh because I've just been watching this for 10 years, and you think every year it can't get worse, and then it gets worse.
Yeah,
Absolutely. It's a bit like politics. I remember when the dying days of the Howard government, I was like, man, this government's bad. But now I look back on the Howard government, they're bloody fantastic compared to the mobs we've had since. Which is an unbelievable situation. Like it's like every government's gotten worse, and then policy's gotten worse. Economic discourse has gotten worse. It's like everything's sort of been corroded in the last. The whole nation's kind of been dumbed down. It's a real shame.
Yeah, absolutely. Well, people want the easy, quick answer, and the very short, easy, quick answer. In 5 words or less, right? It doesn't help. But I guess I just wanted to take the conversation slightly further. So we've got central banks who basically are held up as positions of, prime authority, and they know precisely what they're doing. They're a step above everybody else, right? Now, the central banker's banker, of course, is the Bank for International Settlement. And there's quite a lot of movement between the BIS and the central banks around the world. I don't know whether I'm just paranoid, but it seems to me quite weird that where you've got central banks who are, actually really aligned via the BIS, an international structure that's not actually elected. Central bankers are not actually elected. There's no accountability. When they get things wrong, nobody actually seems to take any blame at all. Now, am I being paranoid, or do you think that's a fair point?
Oh, I don't know. Look, I must admit, I've never looked at it that deeply, but yeah, there certainly is it's probably like nepotism sort of thing. So there's kind of, there's probably this in club. You're in the club, but that also means when you constantly churn through people in the same sort of in club, whether it's from different parts of the BIS, whatever, you're going to always get the same answer. I don't know if it's deliberate or it's just chaos theory. Like, it's just the way things work. I've always been. People often get me that try and tell me there's some global elite who's trying to pull all the strings on not just this kind of stuff, but everything. This global elite that's like pulling policymaker strings and putting us in this new world order stuff. I hear this stuff all the time.
Yeah.
I personally don't believe any of it because I believe in chaos theory, and that if you look at our governments, whether it's a local government, a state government, a federal government, mate, they can't organise a bloody chook raffle. So to try and think that there's some global elite pulling everyone's strings is just incomprehensible, because they can't even organise the most basic stuff. So I don't think so. How can they get the big stuff right? I just think it's kind of like I sort of believe that it's chaos theory.
Yeah,
in my view, because I just don't think the world's that organised.
I call it the cock-up theory of history.
Yeah, cock-up theory. That's fine too.
Yeah. Rather than actually somebody having a grand plan that they're sort of secretly, pulling all the levers, and the chances of them being able to do that successfully, I think is.
Mate, we, as a society, not just in Australia, like globally, we can't organise anything. So it's not like so I don't see how they can be, getting the, all the countries to row in the same direction.
No,
because they can't even get a local government to row in the same direction, or whatever. So it's just it's hard enough trying to organise something at a school committee, let alone trying to get people to agree on when to hold a bloody school fair.
Yeah.
Let alone this this bigger stuff. So I just believe in chaos theory or cock-up theory, whatever you call it.
And there are a lot of these quasi non-government organisations around the world, from the World Economic Forum, the UN, etc. Right, and they all have a certain set of cultural norms and a certain set of behaviours and a certain set of values, which you could actually typify as being sort of aligned to the US predominantly.
Yeah.
That doesn't mean that there is some sort of seed at the centre that's sort of pulling all the strings through all of those entities, right? It's more about.
It's just a bloody talk fest.
Yeah. Well, it's a particular set of philosophies and approaches, and as you say, underpinned by neoliberalism, right, which actually takes you to certain conclusions as to what you do and what you don't do. I think that's probably a fairer and more accurate assessment of how things actually work.
Yeah, you've probably seen the World Economic Forum thing, and there was a YouTube video or whatever going about from their website saying that by 2030 you'll own nothing and you'll be happy or something.
Yep.
Or some crap like that. And I was getting sent that, like, see, they're going to take your house away from you. I'm like, are you serious? Australia, New Zealand, all these places, mate, they're not touching our bloody houses. Like, they're trying to get us to buy more houses. If anything, they're trying to get more, lackeys into the market. That's how you keep them. So this whole sort of notion that there's this global elite that's going to take your houses away from you, and that is like, I just sort of look and go, are you serious? Like, that's not how Australia works, mate. We're all about the house. That's the only thing Australians care about. So if you try to take their house away from them, that's something we might actually go to war on. We won't fight for stuff that's important, but don't touch our house price.
Absolutely. Yeah. Well, the thought of house prices going down is the biggest shock. And I mean, Saul Estlake, he made a submission. Did you see Saul's submission to the recent inquiry into the supply side? And he basically said, hey, you've got to understand the maths here, right? That there's a small number of people trying to get into the market, but there's a large number of people who already have property, and it's a sheer rule of numbers, right? Yeah. You don't want to do anything to rock the boat for that large proportion of people who have property, because if property starts to go down, you're going to piss them off. Yeah.
Well, I'll tell you what's funny about that inquiry. So I wrote a submission to it where I basically... I put data in there, and it was a serious submission, but it was also a bit tongue-in-cheek in that you guys are talking about housing supply, yet that was caused by immigration, and here's the figures. Like, it's obvious, if you ramp up immigration by 140% after 2005, that's what's caused your housing shortage. right? It's not because we're not building enough homes, we build more homes. But so I wrote this submission to it, and it's not cited anywhere in their multiple. It's about 250-page report.
Yep.
And I Googled, like I went in there with a search, like Control F, trying to see if it had even been mentioned anywhere, even in a footnote. No mention.
Yep.
Don't you can't possibly even mention it. Like they didn't even try and play it down. I didn't even get a reference because I'm a heretic. So you can't mention me because I'm unwashed. I'm that loon in the corner who's on this loon website that nobody reads. To them, that's the way they think of it. Which is, anyway, that's the way it is. But no, Sol Lesswake was 100% right in that. And he also, I made my buddy Dr. Cameron Murray and I and Sol all made the same observation in that we've had dozens of these bloody inquiries over 20 years and they've amounted to naught, right? So this is just window dressing. And no doubt when the Albanese government comes in, assuming they win, which I think they will, easily, no doubt we'll get another housing affordability inquiry. I guarantee in the first term we'll get another one. And just like the others, I'm just going to cut and paste my last submission and just send it in because it'll be the same wasted process. Whoever chairs it, whoever the expert who chairs it will get paid his $500,000 consulting fee. And it's just going to be another waste of time. Another one to add to the pile.
Yep.
With the other 20 and nothing will change.
Yep.
Yeah.
Well, I actually have a fairly standard submission that I submit to each of those. It's pretty much the same arguments, right? Exactly right. Just change the date and change a few little facts, and likewise, never get quoted in the final report. Actually, a couple of reports ago, they did actually quote me on some stuff, which is quite interesting. So occasionally, they, I'm sort of just within the ambit, but only just. But not on the supply side issue.
Mate, the only time I've ever been quoted in Parliament or whatever is by an independent. I can't remember. I think it might have been Jared Rennick. I think so. He's Liberal. I think good guy. He's one of the few ones that actually talks sense and a lot of stuff.
Absolutely, yeah.
He should really be an independent.
He asked some really good questions of the RBA in the Senate. Yeah.
He's good. He's one of the few politicians I like. Like I tend to like independents, and Jared Rennick is excellent. But yeah, he actually quoted some of my stuff in Parliament. I was like, yeah, finally. But it's only over the independents, or it's like a rogue like Jared Rennick.
Yeah.
But yeah, like other than that, don't mention MacroBusiness. Don't mention me. I'm a heretic. So, anyway.
Oh, well, heretics are welcome on this channel. There's a few questions that came in. One of them ones that Cookie Boy asked earlier on was about the concept of a national bank. In other words, not a bank that's actually just commercially driven, but actually one that's owned by essentially us, that can invest in infrastructure and can invest in the things that the other banks don't want to invest in. All they want to do is to just lend more stuff for houses. Any thoughts on whether a national bank makes any sense? Because CBA once was a national bank, then it was privatised.
Yeah, I don't think there's any harm. Although I think New Zealand's got that. I think with Kiwi Bank.
Yeah.
And I don't know. I certainly don't think there's anything wrong with it, but I don't know if it's necessarily led to better outcomes over there. I guess it's how you do it, I suppose. But Kiwi Bank was introduced in New Zealand, I think, just to give some pricing pressure to the Big Four.
Yes, it was.
To make sure that to give some pricing pressure on mortgages, etc. And it's obviously done its job there. But I certainly don't think there's any problem with it. I just don't know if it depends how it's set up. If it's set up purely to compete against the Big Four as like a Kiwi Bank style, it's probably not going to change much, really. It'll just give a bit of pricing pressure, but they'll still be way too much, lending for mortgages, not enough for businesses, et cetera, et cetera.
Yep.
If it's done to sort of funnel its profits into, nation building stuff, it's fair enough. But really, governments should just do that anyway. There's nothing stopping the government setting up a, independent, independent infrastructure authority, whatever, and fund it. I'm certainly not against it. I just don't know if it would necessarily make much difference, especially if it's set up the New Zealand way.
Yeah.
Because that definitely hasn't really changed much over there. Like, it's still one of the biggest housing bubbles I've ever seen.
Absolutely. Well, they actually ended up playing the same game as everybody else, actually.
Yeah, that's it. That's it. And if it's just basically a corporatized, corporatized government-owned bank, well, does it really matter?
Mm. So in the last few minutes, I wanted just to explore a couple of other issues. One of the ones is the China connection, right? China is going through a very significant correction at the moment. I mean, obviously we've got the COVID lockdowns, which means that the supply chain disruption and all the ships stacked outside, but we've also got the property sector going downhill very significantly in China. And of course, the deadly embrace of China to Australia is huge, right? So huge proportion of our exports go to China. We import a lot back into Australia from China. And economically speaking, we're still very much connected strongly with what happens in China. So I guess from a local perspective, because I know that other people cover the whole international, what do you think about it from the impact on the local economy here? And is this really going to be another dampener on what's happening ahead, or do you think that we're going to find a way through this?
I think we'll find a way through. I mean, obviously, China's been dropping the hammer on us for 18 months now, and the economy's going strong, but obviously we had a lot of stimulus as well. So it's definitely one to watch. I think Australia has got to shift its focus away from China. I don't want to say anything too controversial, but I am concerned about China's ambitions, I guess, with what's going on with Solomons at the moment. Is incredibly worrying. In fact, I've got mates and stuff who are all they all worry about climate change, etc., which is a real issue. But I worry about this. I worry about the China thing in Solomons, because I think that's the biggest threat to our national security in decades. Having a rogue nation or a dictatorship who controlling one of the Pacific Islands that's basically right there in the shipping lane between us and the rest of the world, who can potentially stop imports coming in, whether it's fuel, whatever, and then strong arm us on all sorts of issues is a real worry. And I think that should be the number one focus of the incoming government, how to solve that issue. And unfortunately, it hasn't really received much attention during the election campaign. And
again,
Australia, Madeline Suzette just said Australia needs to diversify. Absolutely, we need to diversify. Unfortunately, the world's done it to a large extent. They've given up their manufacturing capability, shipped it off to China, and now it's come back to bite them. And this sort of gets back to our thing we were talking about earlier, where the world's got to go through a period of deglobalization, and that's effectively, to a certain extent, decoupling from China and shifting elsewhere. And I think that's going to happen anyway. But Australia needs to definitely reassess that relationship. But easier said than done, given we've basically tied ourselves to the hip to the China economy over the last 20 years, which is pretty stupid, really, in hindsight.
Yeah, and the property sector over there is absolutely, it's toast, isn't it?
Oh yeah, it's stuffed, and we're seeing it there. This is obviously, I guess, a more shorter term issue, but obviously their COVID zero approach is absolutely ridiculous. Locking down, major cities, etc., in this pursuit of COVID zero, and basically, bringing in the special police, I guess, to police your own citizens. We saw that to a degree in Victoria last year. I did when I was in Melbourne. Yep. It was pretty bad. I think China's got that on a huge extent, and it's a lot of civil rights abuse, human rights abuses, etc., going on over there. So it's definitely a nation I don't think Australia should be getting into bed with, which we have to the extent that we have. But I'm trying not to say anything too controversial. I'm trying to play a straight bat.
Fair enough, but hard to unpick when we're so interlinked. But I guess we'll see. So there's a few other questions that were whizzing around in the chat. One of them was the energy question, right? So clearly in this election, there isn't a lot really being spoken about energy and energy substitution. But there is a big question, economically speaking, about how the economy is going to work, because, of course, the cost of oil has gone up significantly and will probably stay high. Now, that may create significant profits for our, companies that are involved in the sector, although a lot of it goes offshore again in terms of profits because we have a lot of international investors. On the other hand, the investment in renewables and things as well, it's there, but it's not necessarily going at the speed that some would want. How do you see the energy puzzle, and do you factor that into the economic model that you've got in terms of the way you see Australia working?
No, I don't, because it's more long term. So I tend to look at, I guess I used to look further ahead, but it's sort of pointless. So no, I mean, because things change so much. So my horizon these years is like what's happening the next year, and then you kind of think, oh, what could happen the next couple of years? But certainly in some ways, a little bit like the pandemic was great as a change agent to change the way we work. Right, we've got work from home's become normalised now. I've been doing it for 10 years. You've been doing it for a long time, but people I knew who only ever worked in the office now are almost working at home the majority of the time now, and they don't want to go back to the office. And it's been a great change agent. Like, I think society was going there anyway. It would just might have taken another 10 years. I think this whole energy shock we've got now, which is a little bit like a mid-1970s oil shock, could actually be a really good change agent. And it will hopefully force us, off ridiculous reliance on fossil fuels, but also imported oil, etc. And hopefully we'll drive some change into, whether it's at the household level, people buying electric cars, etc., instead of the next car being a petrol, or hopefully more at the political level, which is where it needs to get driven. I think the next 5 years, it should accelerate a move to renewables and to electric cars, etc., etc. I think it's an unstoppable force, really. It's going to happen regardless. It's just whether Australia becomes, lags. We're always a laggard when it comes to this stuff. It's whether or not we're, get dragged kicking and streaming into it, or we sort of come a little bit more, willingly. I think this whole rising energy dilemma, etc., is going to accelerate that process, just like COVID accelerated work from home. So I think long term it's going to be great, or medium to long term it's going to be great. But of course that means in the near term it's going to be an absolute pain in the backside, because we're all paying $2 for petrol, and you can't just turn on the switch and have these things happen. But yeah, it's going to be a fantastic change agent, I think. Like it's really anyone who cares about the environment, who cares about emissions, who cares about sustainability, and that should really be cheering on. Not saying cheer on the war. The war is terrible, but cheering on these higher global energy prices, because it's going to force change, and force change quicker than it would have happened otherwise if petrol prices remain cheap. Obviously, if you've got cheap fossil fuels, there's a lot less willingness to change because everything's peachy. But if fossil fuels are rocketing in price and cost, and everyone's feeling it in the hip pocket, well, you're forced to change. And I think that's a good thing.
Yeah, absolutely. Well, I think change is afoot, and you're right. I think the catalyst is there now. Well, we've got a few minutes left. There's one other topic I wanted to touch on briefly, and that comes right back to housing, right? Because there are two policies from the two sides of politics, right, with regards to helping housing, right? So you've got the Labor one, which is effectively an equity-based program, and you've got the Liberal National one, which essentially is helping with the gap between deposit guarantee. Yeah. Neither of them very big, neither of them going to really move the dial much. But do you see any merit in either of them, or do you think they're just messing?
Not really. No, I think they're both just more of the same of what we've had the last 20 years. Just bringing more first home buyer or home buyer patsies in the market. We know from the last 30 years of observation that these demand side measures don't work. We know that because obviously prices have rocketed more, and also home ownership rates have collapsed. So we've had all these schemes to. I saw Leslie in his submission to that housing affordability inquiry said it beautifully. He wrote a whole section on it, saying that we've had generations of this stuff.
Yep.
And we know it doesn't work because it just, it's kind of, in economics, you've got this term called tragedy of the commons, which is basically what's true of the part isn't necessarily true of the whole. So while a first home buyer grant or whatever can make me individually better off, it doesn't make me better off if everyone else is also applying that same first home buyer's grant, because all it does is just end up pushing up the prices. So it's one of those things that, to the individual sounds great, but it's not great when everyone's doing it. And that's effectively these sorts of policies. If you push up the system cost price of housing, although people are going to spend more to buy that, the price has gone up because of the policy. So it doesn't actually, it's self-defeating. And that's effectively what we've had in the last, 20, 30 years, because we've had non-stop demand-side stimulus that's just resulted in higher prices and lower home ownership rates. And that should be proof positive that doesn't work. But again, it gets down the politics of it. Politicians want affordability, but they don't want prices to fall and prices keep rising. So this is how you argue for affordability without actually fixing the crux of the problem. So it's really just they're both political measures. They're not going to work. I think most economists, even the captured ones, would agree that they're not very good. Then they're self-defeating. So unfortunately, Labor. You can't really blame Labor. Coalitions was always going to do this. That's their MO. Scott Morrison used to work at the property council, for goodness sake. But Labor did actually try and do some reform last two elections, and they didn't win. So they've been spooked, and as a result, they're just doing the easy road, just taking the easy road, just trying to do something that's politically popular, and is actually going to end up making the situation worse, albeit at the margin.
Yeah, absolutely. Well, it's quite clear that those programs have no real long-term benefit other than lifting prices even higher. They sound good politically, so you might get a bit of media coverage, and then people think, well, they must be doing something then for housing, but they're not. Nobody's tackling the fundamental issues that are structurally there, as and I know, that have been there for a long, long time. House prices are way too high relative to income, relative to GDP, and there's no real intent to deal with it, as far as I can see at the moment. Right? Oh
no, absolutely. I was trying to get back to the tragedy of the commons thing. So it's almost like, think of it as if my parents. If I was looking to buy a first home buyer, my parents gave me $100,000 to buy my house. Obviously, that's going to help me out, right? But if every parent gave their kid $100,000, well, then you're not better off, because prices would just rocket across the board.
Yep.
So you end up just, you spend all this money, but you've just driven the cost of housing up. And that's kind of what these policies have done.
Absolutely.
So they do sound appealing on the individual level, but if everyone's doing it, and it applies across the market, they're no longer appealing.
No, and the only beneficiaries are actually the construction sector, because they get paid to build stuff, and the finance sector because they can lend more mortgages. Yeah,
that's right. And they just fatten their margins. So
exactly.
Yeah, it's just unfortunately, I'm not surprised they've done it. In some ways, I'm relieved because they're not worse. I've become that cynical now, where when I read a federal budget, and I get slammed sometimes because I'll give my hot take in a budget, right? You do it. I posted it about 8:30, so an hour after it's come out, and it's my initial view. And often it's people go like, "Why aren't you slamming this?" It's like, because I expected it to be so much worse. Like, it exceeded expectations, because it only had $20 billion of pork, not 100. And because I always go into these things expecting them to be a lot worse, when they end up not being as bad, I'm relieved. And in some ways, I was expecting these home buyer policies to be worse. So, they're not good. They're going to make the housing affordability situation worse at the margin, but they could have been a lot worse. Like, at least there are, pretty small numbers applying to them. There are limits, although I bet you those initial numbers that they've mentioned are going to get expanded. The limits will keep getting raised, because when a whole bunch of home buyers miss out, they'll whinge, and the government go, oh, gee, this is such a successful scheme. Well, let's expand it. and it'll just make the situation worse.
Yeah. Well, ScoMo has been very quick to point to the 300,000 or something people who've been helped over the last couple of years with his programs. But, it's an interesting question as to how helped they really are.
Well, yeah, and obviously, meanwhile, the poor suffering renters are suffering through, the lowest vacancy rates on record, or at least in generations, and rents that are rose nationally by about 10%. So, they're the ones who are really copying it the hardest.
2 million renters are in rental stress, according to my analysis at the moment. That's way.
I wouldn't be surprised at all. I mean, they're. Renters tend to be obviously lower income earners.
Yep.
They're more paycheck to paycheck, and they're way more sensitive to these sort of rising costs. So, I think rents have risen more it's probably close to 20% over the pandemic, over 2 years, or maybe 15 to 20%. So it's, very high rates of growth. And obviously that's a broad average. There are some areas like regional Australia, some markets where, rents have gone ballistic. I know a guy on the Gold Coast who's earns good money, about my age, one of my friends, who has not been able to get a rental on the Gold Coast. And he's doing 20-page application forms.
Yep.
And the reason why they're reluctant to rent to him is because his wife passed away last year and he took 6 months off work. And because he doesn't have a stable employment record, he just can't get a rental, even though he's a perfect candidate. And it's just a nightmare. Like he says, he goes, mate, it'd be easier for me to get a mortgage than getting a rental property. That's how hard it is up there. Yeah. So it's just crazy.
Yeah. Well, I've had a few people who have basically chosen to hock themselves for a mortgage, because there's no way they can get rental accommodation at all. And so they're actually digging a deeper hole for themselves, particularly with interest rates now going to rise, but they had no choice.
Yeah, that's it. It's almost sort of panic buying in a way. It's a form of panic buying because it's like, well, I can't get a rental, I don't want to be homeless. So, I'll just go and pay way over the odds for a place just to get myself out of the situation. When then you just put yourself in another situation.
Yeah, absolutely.
So it's
absolutely.
Yeah.
But it's interesting that in the election campaign, almost renters has not been mentioned once, I think, in any policies that I've seen from anybody.
No, I think there was a very brief chicken feed policy on social housing. I think from Labor, minuscule.
Yep.
But really, renters are forgotten, and they always seem to be forgotten. I don't know why that is. Especially given the renting constituents are starting to become bigger. Like obviously we've got more people renting now than there was 20 years ago because home ownership rates have collapsed. So you think they'd be becoming a bigger political voice?
Absolutely.
But for some reason they're still silent. I don't know why that is.
Yep. And actually, it's quite a good way to finish the show because the point I want to make is that two quite interesting charts, which I won't show, but just the proportion of lending to business versus housing has completely switched in the last 30 years, right? It used to be 2/3 business, 1/3 housing. Now it's the other way around, right? And the second is that the proportion of people who own their home outright continues to drop. The proportion of people who have a home with a bigger mortgage has gone up a little bit, but that mortgage is owned for a lot longer. And the proportion of people who can't get in and are renting has gone up too. So however you look at that sort of series of data points, it's broken.
Yeah, it is, and that's spot on. So that mortgage and business lending data comes from the RBA. 100% right what you said. And I think last time or time before we mentioned it lined up beautifully with the implementation of the Basel Capital Accord. So I think it's probably a global issue, but the Bank for International Settlements and the global prudential regulators, central banks, etc., effectively dramatically reduced the amount of capital that banks have to hold against mortgages, and lifted the amount of capital they have to hold against businesses.
Yep.
And then that came in 1988, and effectively that correlates perfectly when mortgage lending exploded and business lending tanked. And all that shows you, a bit like what Sol Essay was saying with the first home buyers grants, is we've had all this credit pumped into housing, which has inflated prices, but has actually reduced home ownership and has actually reduced, the amount of people who own the house outright. So effectively, we've all just, the only party that's won out of this has been the banks, really, who've now got us on this, as I said last time, we're all on a subscription service, paying a mortgage for, decades now, when used to have one for 10 to 15 years and be able to pay it off. And that's just sort of, the system, the financialisation of the housing market that's happened over the last 30 years, pretty much over my lifetime. I wish I'd known. If I was young, I'd probably be one of these property parasites who owns 10 properties, I don't know.
But it is true. I mean, the average mortgage is a lot longer. People hold them into retirement. So when they go into retirement, they've still got a mortgage to pay off, which is what they use the super sometimes to do that.
Actually, for the listeners here, if you get a chance, I've got to give it its credit. Per Capita, the think tank, put out a housing report last week. I put up MacroBusiness a few times. It is absolutely fantastic. It's probably one of the best. See, Vanessa, it's probably one of the best, best housing reports I've read from one of these think tanks, and it just explains beautifully how home ownership has been destroyed over the generations.
Yep.
And because most affordability measures only look at the first year initial mortgage repayment, and it's the wrong way to look at it. Whereas this report looks at the lifetime cost.
Yep.
And it's something I've argued for years. It's basically Peter Martin called it the mortgage tilt, where basically, because of low interest rates, your upfront mortgage repayments tends to be less because interest rates are low. Because you've got low wage growth as well, and the principal's so high, you end up repaying that mortgage over decades. Whereas previously, when inflation was high and interest rates were high and nominal wage growth was high, you effectively pay high mortgage in the first year, but then that reduces really quickly because your debts are inflated away.
Yep.
And this report shows that beautifully, and it shows basically how home ownership rates have gotten worse every 5-year period since the baby boomer generation was born in 1945 to 55, and it's just gotten worse and worse every single period. And they also estimate that the Generation Xer now is paying $1,000 more than they would be if they're on the same trajectory as a pre-boomer generation, because they're paying mortgages for so much longer. It's a fantastic report. If you like data and that sort of stuff on this sort of issue, it's well worth a read.
Absolutely. No, it is a very good one. And I think I've mentioned it in some of my shows as well, because it really does highlight the
lifetime cost.
Yeah, absolutely. And that's the point. People are paying more for longer, right? The banks are loving it because, as you say, you are a cash flow, right? And that's almost close to what the World Economic Forum. You'll be happy because you won't own it. You'll still be paying for it, right?
Yeah, actually, maybe they are right. They just they weren't talking about renting. They were saying you're renting because you're paying a mortgage for, what's next? We're going to have, Japanese style 50-year mortgages, 100-year mortgages.
Exactly. Intergenerational mortgages. Why not?
Yeah, that's it. So, I always look back to my parents. My dad hates when I do this. He's a boomer, so he's like, interest rates got 17%. I'm like, yeah, Dad, you had your house paid off in 1982, mate. 10 years after you took it out. But he, obviously, periods of high inflation, high nominal wage growth, and you pay when you paid a small amount for your home relative, like 3 times your income, and you had high inflation and high nominal wage growth, even though interest rates were higher, you pay it off real quick.
Yep.
Whereas now you take out a jumbo mortgage day one, you've got low wage growth, low mortgage rates are rising. You're stuck paying this chunk that erodes really slowly over time. Like even after 10 years, you're still paying a massive mortgage.
That's right.
That's kind of the system we've got now.
And then you draw down more equity.
Yeah, that's it. So it's all, you just, equity, mate.
Yeah, exactly. Leith, thank you very much for that. Really enjoy the conversation. You always have so much to contribute, so thank you very much. There was Jason did ask one question, which he was talking about US farmland, the cost and what have you. I actually don't know the answer to that, Jason, but I appreciate the super chat. I got no idea. Sorry, Jason. I'll have a look offline, and if I get some more information, I'll make a show or comment it next time.
I suspect it'd be cheaper than Australia's though, because
it's not hard. I mean, look at the relative house prices of the US and Australia, right?
Yeah, that's it. Like, yeah, it's not hard. It's probably actually. I guess it depends. What I'd say, like for like, the farmland would be cheaper. But obviously, if you're going, Central Australia where you can't grow anything, it's probably pretty damn cheap there as well.
Absolutely. So thank you very much, Leith. Really appreciate it. We must do it again soon, and keep on those blogs, and you doing your own videos as well now. So we'll put those links and things below.
Yeah, so basically, they're nothing like yours. I've started I'm tinkering with YouTube, and I'm doing these, like, they're called macro breakdown. So basically, it's I've only done 2 in the last 2 weeks because I've had work done literally in the next room because you've got a leak in the bathroom. So I've got workmen here during the day. So I haven't been out actually because during the day this is like noise. But it's called macro breakdown. The channel's Leith Leithvo. That's how you find it. And basically, it's just like short, under 5-minute videos talking about a topic. I only do a couple a week because I'm very busy writing the blog. But, I've been talking a lot about interest rates lately and why the markets are mad. And I'll just basically give a short breakdown, a few charts, etc., talking about it. It's nowhere near the production value of this channel. But, if you like, bite-sized content, which is less than 5 minutes of me, just yabbering on with a bit of data. Just think of it like a macro business post, but with word, like me talking about it, and usually bagging the markets on interest rates or their loony projections or whatever.
Oh, well, I reckon you were on the slippery slope. That's how I started about 10 years ago, and now look at me.
yeah, that's it. Well, I mean, look, I'll be honest with you. The hardest thing's the editing. So. Anyway, but check it out if you want to. Leithvo, Leithvo. That's my YouTube channel. A couple of times a week, just short videos, nothing like this. You can probably see my whole week's content in about under 10 minutes. So it's not. But anyway, if you're into that sort of stuff, and you like me yabbering on, give it a crack.
Great, Leith. Thank you very much. I appreciate that. I can take you offline now, and I'll close the show. See you later.
All right. See you. Martin. Thanks, everyone. See you.
There we go, folks. So, well, we're over time, but I wanted to spend a bit more time with Leith there. And just to say that next week, I've got Steve Keen's coming back with Victor, who's the leader of the TNL. We're going to have one last conversation about making your vote count, and a chance for both of them just to effectively discuss what they've seen through the election campaign and how things have played out. So if you're interested in more discussion and political discussion, economic discussion, the interface, that'll be next week. And I will just say that the doggies, well, we've got one doggy. I'm not sure where the other doggy's gone, but there's one doggy still sound asleep there. So there you go. The doggy cam is still on. So anyway, thank you very much for spending some time with us tonight. Really appreciate it. And we'll be back next week with another show, or you can watch our recorded shows during the week. Have a good evening. See you soon. This is Martin North from Digital Finance Analytics, signing off. Cheerio.